Okay, let's see. Good morning. Good to see everybody. Hopefully everybody had a great night last night. My name is Rich Vandenberg. I'm going to moderate today's session, which is succession planning and ownership transition that will be presented by Scott Lockwood. Scott is a CPA and a partner in charge of the advisory division at MMB Company. The firm is a longtime supporter of the New York State Brewers Association, serves breweries throughout New York State. Scott has spent half of his 20-plus year career in public accounting and half as the CFO of a large engineering firm. His advisory services team at MMB works with clients on a range of matters, including succession planning, M&A, outsourced accounting needs, and fraud. I can say Scott, too, is a good friend. He's actually been and their firm has been huge in helping the Brewers Association kind of get their hands around our budgeting with advice and a lot of great intel. So, Scott, all yours. Thank you.
Well, thanks, Rich, and pleasure to be here, and pleasure to do this session today on succession planning and ownership transition, which, frankly, there probably should be about 40 more people in this room. I'm surprised there's not, but nobody wants to talk about that publicly sometimes. Maybe it's time to exit. So as Rich said, I've been doing this 20 plus years now. About half my time is in public accounting. Half my time was in the private sector, actually, working as a CFO, a controller, in the business, running the business, owning a business, being an owner myself. Going through ownership transitions on both sides, so on the consulting side and living through them. So either buying a business or on the sell side too, we sold a business. So I've been through the ringer many times here. So I guess well positioned today to talk about this whole idea of succession planning and ultimately the transition of ownership of your business. So I do a lot of advisory work on the planning side, supporting mergers and acquisitions, help with deal negotiation, deal structuring, tax planning, and then ultimately post-transaction integration planning and execution. So one of the things that often happens is everybody gets the deals done and everybody's happy, but they forget about day one of the new business. So we do help out with that as well. So one of the first things I'll ask a client, when a new client to us or prospective client, are, what are your plans? And some say, well, I don't have any. We're just going to keep running the business. That's great. Totally fine. Some say, yep, we want to grow. And then others come to us and say, yeah, I'm done. I've had enough. I want out. Help us out of the business. So everybody's different. Everybody's business is in a different life cycle, for sure. But what I can say is succession planning doesn't need to start when you're thinking about the exit. Succession planning really should start almost from the very beginning as you get into a business, thinking about what that future exit might look like. It might be 30 years away, but it's never too early to start thinking about that. So with an exit, what do we talk about here? What does that really look like? There's a few different options in this industry. I think all of these can be on the table. So one, selling to a competitor, another brewer, bigger brewer maybe somebody locally that knows you. Selling to a larger company. So the idea of Anheuser-Busch or somebody coming in and buying up your particular niche little brewery. It doesn't happen all the time, but certainly has happened over the years. We've seen some breweries merge in together and say, hey, we're all good friends. We're 2 doors down from each other. This is silly to run separate operations. Why don't we bring it together for the greater good? A great way to exit a business and kind of leave some legacy with that. One of the things we see a lot in our client base, not just breweries, but the owners really have a real close bond and real family atmosphere with your employees. And whenever we start talking about selling or exiting the business, I'd say 8 times out of 10, the first thing that comes out of the mouth of the business owner is, I'm worried about the employees. I want the employees to be taken care of. I don't want their lives to change, which is great. It's admirable. It's everything you want in a leader. But when you're talking about exiting a business, sometimes that part can't happen. Quite often that part doesn't happen, where the employees' lives aren't changed. So what we often hear is, well, I'd just love to sell this to one of my employees. You know, Joe's my general manager and he's been doing it for years with me. He's great. I'd love to sell it to him, or a combination of those folks that have made the business successful. So certainly an option. The other side of this is just closing. You can just close the business. No one really wants to do that, but that is happening more and more these days, where you're seeing businesses, in some cases very abruptly, closing. And closing because typically of cash flow problems. They don't have cash to meet payroll. It's a real issue right now. And I'm sure many of you have lived those days of being tight on cash and, well, I hope that check clears. I hope the distributor pays me this week because I've got payroll coming. And sometimes people have to sell close and ultimately sell off their equipment. So your industry, this business, obviously you do have equipment that has value, which is great. You have debt typically along with that equipment, but you do have the opportunity to actually sell some of that versus a service business where you really don't have any hard assets. We are seeing that more and more happen here, where there is just a closure of the business and an ultimate sale. And then the other one here, private equity. Does anybody know what private equity is at all? So private equity, back in 16, 17, 18, started to come into the brewery space, the alcohol space a little bit more. And what private equity is, for those that don't know it, basically a bunch of rich guys that have a lot of money, they all put it together and have somebody go out and buy up businesses to help them make returns greater than they would get investing in the stock market, public stock market. So these equity firms will create these little funds and they'll say, okay, we have $2 billion, we're gonna go out and buy up breweries, distillers, you name it, there's a fund for everything. So those guys will come in and buy your business if it meets the criteria that their fund is looking for. Oftentimes the private equity buyers have cash. They want to come in, give you a bunch of cash, own the business, and get returns. They'll promise you that they won't do anything or change anything, which they might not, as long as you're making them money and making them returns. So private equity is an option. We've seen it a little less in this space, I'd say, over the last couple of years, but it certainly is out there. So what do we see? What are the most common ways to exit the business here that we've seen in New York State? A lot of times it's that sale to somebody familiar or close to the business. So an employee, a group of employees, frequently we'll see somebody who's been a customer, who's come in the brewery, the tap room, that's been interested, somebody local in the business community that wants to keep something local. That happens all the time. We're also seeing now some just sale of the brand. So for any of you that are from the Rochester area, Young Lion sold their brand off this year, sold their equipment, closed their facility. To the extent you do have a brand, your brand may have value in and of itself, and you can sell that brand. It's an intangible asset that you have that could have value to somebody else, to another brewer, perhaps to one of those very large beverage companies. Very, very much an option to sell the brand. Again, sell the equipment. a lot of places in Western New York especially, and some certainly down in the city, if you do own real estate or have real estate, there is oftentimes a lot of value in the real estate you have. So if you have a brewery that's on the lake, you could very well have seen that real estate appreciate 10, 15, 20 times what you paid for it 20 years ago. So there can also be a lot of value in selling the real estate. And then, as I mentioned earlier, this idea of a distressed sale where there's bankruptcy involved or some other type of issue with the business that is forcing a sale, essentially. Obviously, that's the last option anybody wants, to get into that space, but the reality is that does happen, and we're seeing it more and more. Not so much in New York. I think somebody yesterday mentioned Colorado and the reduction in breweries in Colorado. It's happening. You know, somehow my Google feed and the AI has figured out I'm interested in bankruptcy stuff, so I see these brewery bankruptcies popping up all over, and most of them have been in other states at this point, but you know, continues to be a real issue. So when we talk about succession planning, it's not so much about the numbers. So I'm an accountant, a CPA, this is a finance-related topic. We're not going to talk about numbers really today at all. This idea of succession planning isn't so much about numbers and dollars and cents, but it's really putting together a plan and setting goals. So how do you do this? I never had any training in succession planning. I didn't go to college for it necessarily, but for 20 years of doing this, we figured out it's not that hard. You just have to do it. So again, when we talk to clients, it's about what are your goals? What do you want to do? And what are the exit plans? And we always talk about that. And typically nobody's done anything. Or they say, oh, yeah, I'm going to go 20 years and we'll figure it out as we go. That's too late. So as you start thinking about these things, it is really important to sit down and establish the goals that you have. What do you want out of an exit or succession or ownership transition, whatever you want to call it? That's very different for every single person. There's some people we talk to and they say, I want as much money as I can get. I don't care. Period. End of story. Okay, that's fine. We can create a plan for that. As I said earlier, it's about the employees. People want to hear from or be able to take care of their employees. Some people it's legacy. Some people it's transitioning down to their family members. You name it, we've probably heard and seen all of it. So it's important for each brewery, individual owner, to have some goals, some idea of what that end result wants to be. From there, putting together a plan, how are we going to get there? How are we going to make these goals reality? If it is, we want as much money as possible for this business, we might have to operate a lot differently than we do today to maximize that return. So planning, very important. Ultimately executing on that plan. So again, that idea of succession planning isn't going to start and happen in a course of a month or two. It's going to be a long-term, long haul plan to execute. And then ultimately, after you've executed that, you're going to exit. Very simple, right? Four little things, but it certainly isn't. So with the goals, what I look at here is really understanding what that end goal is. So do you want money? Is money that driver? Do you want control? People love control. As much as they say they don't, they do. Even if they want to leave and be out of the business, sometimes they still want that control over that business. Family, legacy, the employees. Some people just want to get out and do something different, totally different. So that's okay. So as you set these goals and think about these goals, I think it's important to say, are they realistic? Are we going to be able to achieve these goals? One of the biggest unrealistic goals we see is money in financials. we'll hear, I want $1 million for this, I want $2 million for this, I want $3 million, whatever the number is. And the reality is, it's not worth $1 million, it's not worth $2 million. It might not be worth $500,000. And that is very difficult for people to deal with, but it's realistic. And as we go through this, we'll talk about, business partners and people that can help you come to that realistic expectation of what's going to happen. And it's not just money with realism, it's the other stuff too. You may want your family to take this business. They may want nothing to do with it. And it happens all the time. The employees, same thing. Is it realistic that an employee is going to be able to afford to buy my business? I'd say 9 times out of 10 we find that isn't the case. It's either not affordable or they actually don't want it. They don't want the headaches. They see you dealing with the headaches and they don't want that. Which comes to the resources. Do people have the resources to do this? Do they want to do it? And then, creating these goals and the options to get there. How do you figure all that out? Don't do it by yourself. That's typically my first recommendation. Consult with others. Third parties are an excellent, typically unbiased third party. They can help you evaluate these goals, to think about these things, to bring that realism back to you. Other brewers that have gone through it, I think, are a great resource. People that have been in the industry, they've been through it, they've lived through it, once, twice, 3 times maybe, can also provide a lot of great perspective of what it really is like to go through a process and really provide that realism of what this looks like. We get this a lot. Friends and family can be okay as long as they are being realistic with you. We hear a lot where a client will come in and be like, my buddy, he sold his business for $10 million and this is what he did, and you're telling me I can't do that. They don't understand that those businesses are very different. Things are very different. So friends and family can be great, but just be cautious there with the close relationships. And then as I said, as you're establishing these goals, trying to value the business is typically the most difficult thing you're going to have to do. Almost always people overvalue the business. They're not realistic with the value of the business. We see it a lot with breweries, with wineries, distillers. It's hard to make money, and on paper, it's really hard to make money as well. So those losses oftentimes show up, and it's hard to overcome that. And the brewer will say, well, I've got so much value in my brand and my equipment and this and that. And we always come back to, well, you're losing money. So people don't want to buy things necessarily that they're losing money with. Yeah.
I have a question about valuation in the brewing space. You guys deal with a lot of breweries. When you look at like a net operating income of say $200,000 for your business plus your real estate, what are the trends that you're seeing on cap rates, on what they're crunching those numbers for valuation? What are you seeing recently?
Actually, I've got a valuation guy right here that does valuations. I don't do valuations,
okay.
So I personally don't do it. Our firm does it, but Dean, I don't know if you've got any insight on that.
Yeah, probably a multiple of seller's discretionary earnings, which includes net operating income. You add back seller salary, if there is a seller's salary,
yeah,
and any depreciation out to 1 to 2, 2.5.
Okay.
At that level, and as that number gets bigger, the multiple can grow. You cross about $500,000 of threshold at that threshold in SDE or EBITDA, then you might get closer to 3.
Okay, thank you.
And again, you're seeking that outside advisor to help. So Dean has a business that does valuation. Our firm does valuation. There's other third parties that do valuations. Some do them just specifically for the brewery industry. So that's a great starting point for somebody that really doesn't know. and wants that true third-party perspective of what it may be. And that's a great place to start. And it's not terribly expensive to do that. And it does really help give you that realistic picture of what that means financially. And then from that, taking that, whatever that number may be, maybe it's $500,000, maybe it's $1 million, whatever it is, what we see a lot is a business owner will get that number in their head of, hey, somebody valued my business at $500,000 or $1 million. I'm going to walk away with $1 million. And that is not realistic. So where we try to come in and help is say, okay, that's great. So if we get $1 million for this business, you've got $150,000 of debt left. So $1 million minus the 150, you've got taxes you're going to wind up having to pay. You've got an attorney, an accountant, an advisor. So all of a sudden that $1 million starts coming down, and you're wound up with maybe $300,000, $400,000 after all is said and done. That might change the reality and the realism of, can I do this? Is $1 million enough? If I don't want to work anymore, do I have retirement? Do I have Social Security? Is this enough to live? When we have those discussions as part of a succession plan, it helps start to change some of these goals and set some of these goals a little bit differently for people when they do this. So I had a guy just this last week who's got a business, service business. The business is struggling. It's a great business. It's growing like crazy, but he can't raise capital. He can't get anybody to invest in the business. And he's made some very dumb decisions over the last 4 or 5 years that have cost him. And we've come in to help him. And his succession plan was, I'm going to grow this company from literally nothing, and I want to sell it for $15 million in the next 5 years. The first day I said, that you're crazy. That's absolutely insane. How are you going to do that? Well, we're going to sell more of this. We've got this. And it's a great story, a great pitch, but it's not realistic at all. So we for the last probably 4 months have been going through plans to help with cash flow and how do we really make this business viable. And it's not by itself. He needs to sell it. And the reality is he's going to sell that for maybe $1 million, maybe $2 million. He's got good contracts that are great, that would be great for a big company to execute, and they have value for that company, but not for him and not in his world. So what we did is literally sat down and he said, okay, if I get $2 million from this, I've got all this debt, I've got to repay my son, I've got to repay this, I've got to do this, taxes, I'm going to wind up with $300,000 after all is said and done. He's got a pension, he's going to have Social Security, we do the math, stretch it out, and he says, I guess I can live on that, whatever the number ended up being, $70,000 or $80,000 a year, I think it ended up being. And it was a good sort of step back where they said, you wanted $15 million for this thing. That was your goal. And the reality is you don't need that. As we went through these realistic process of coming up with value, coming up with cash flow, and understanding where the money is going to go. So as we talked about value is one of the hardest things to come to. There's some math involved in a valuation and a calculation you can do, but there's so many intangible things that matter to a buyer. Cash flow, as I said, the brand itself, the location, what is your equipment like? Is it old? Is it falling apart? Have you taken care of it? Are they going to have to reinvest in it? What kind of debt does the company have? What does your staff look like? What is your brewer, your head brewer? Are they going to stay? Customers, sales mix. All these things can impact value, positively and negatively. So customers. So if you have one big customer that represents 90% of your sales, let's say, that's going to create a risk for a buyer if that customer goes away, which will impact potentially the value they're willing to pay for the business. competitors, economy, and interest rates are all certainly factors that go into valuing a business in today's day and age. Has anyone had a valuation done of their business formally? A couple of you? Where did it shake out? Was it higher, lower, about what you thought?
Probably about what I thought.
Yeah? Okay. So, planning. So how do we execute, how do we get to our plan? How do we execute this? And again, it really depends on what those goals are. So if it's all about money, you're going to run your business in a manner that is as cost efficient, short-sighted. Let's make money, as much money as we can, so we can do that valuation. And on paper, we have these great numbers, and we hope that a buyer is just going to buy us off those numbers and not really look under the covers of, we've really cut costs over the last 2 or 3 years and we've run as lean as possible and people are at the brink of cracking. That may get you more money at the end of the day if that's your goal. Your people are going to be miserable, but that may work. So your plan may be very different. If it is viable to sell to an employee, transitioning the business and creating a plan that's going to do that, again, very different. So Kathleen, who spoke yesterday from Chevetta's, talked about the family business and they didn't have a plan. And she was going to take over and then all of a sudden it was like, well, here you go. Here's the plan. Let's sit together and we'll help you figure it out. Made it hard, made it difficult. So having that advanced plan certainly would have made that transition for her easier and would for an employee as well here if they were the ones buying the business. Leveraging the experience of others, again, don't do it alone. As you're creating these plans and thinking about it, how does an attorney play into it? How does an accountant play into it, or an investment advisor, a friend, whoever it may be? Don't do it alone. Don't do it in a vacuum. Communicating the plans to the appropriate parties. Again, those folks I just listed off. And really get your ducks in a row. Be organized. Really take a self-inventory of you and your business and what it's going to look like to someone else coming in to look at it. What are the questions they're going to ask? So as we talk about executing on this plan, again, communicating. This is one of the biggest downfalls of any ownership transition is poor communication. And it's across the board, it's internal, it's external. When the attorneys, the accountants, the brokers all work in separate silos and nobody's talking to each other, things get screwed up. And it costs you way more money in the long run when people aren't talking to each other, when they're not communicating. You may think there's a cost to that. Yes, it's going to cost us to have these people in meetings and things like that. But in the end, what I found is we end up spending more time and effort on the backside trying to clean up something that we could have dealt with early on had everybody been communicating with one another. So important to talk through those things. And then other key stakeholders as well. So your management team, maybe it's a distributor, maybe it's the landlord. Getting those people involved and communicating to them as soon as reasonably possible is important. Oftentimes we'll see people just don't want to talk about it. We don't want to scare anybody. We're going to wait till the very end and then unveil this whole, we sold the business. And that doesn't always work. Yeah.
So you own a building, it's worth 500, that's hypothetically, you own a building, it's worth $500K. And you've already paid off 150 of it, so you have 150 in equity in it. How do you avoid spending all of the projected profits that you're going to make on stuff like this? You've already invested all your money in the building, in the business. You might walk away with, say, 300K if somebody's willing to buy it for 150,000. But then you bleed so much money in the transaction fees. So how do you avoid something like that? And what are you seeing in small business owners as they are transitioning? Because reality is these businesses aren't worth millions, they're worth, say, 100, 200, 300, and that's gonna put your nest egg away
Yep.
for future. How do you avoid dealing with, your attorneys, your accountants, your banker, your business broker? All these people are gonna take a percentage of that, and by the end of it, it's like, well, your 300 is now shrunk to 200. How do you avoid spending $100,000 on that?
Yeah, but we hear it a lot. I don't want to incur all these fees. How do I avoid it? You can avoid it. You can just not use them. There's a lot of risk with that. So if you want to use your local, Joe Smith attorney with one shingle, he's the only guy that works there, and he's never done a transaction, or maybe he's done one or two. You certainly can do that, and he's going to charge you $500, whatever it may be. Which, if everything goes smooth and there's no issues, then yeah, great, you got out of it for $500. But if there is something that comes up, and this comes back to how complicated is the transaction, I guess. If something comes up a year later, 6 months later, and the buyer sues you for something or wants more money out of you because the contract wasn't very good, then it ends up costing you more in the long run, potentially. So same thing with accountants, anybody. You can do it yourself, but you do run the risk of not knowing and missing something that ends up costing you in the long run. So it's that balance of risk, and that's kind of where this all comes back to, is how much risk are you willing to assume? Because deals do go bad, and everybody shakes hands, and you'll see in here, I say get it in writing. Everybody shakes hands, and then 2 days later, I've seen things just fall apart, and everyone hates each other, and they start suing, and it's not fun. And even in small deals. So yes, no one wants to pay those fees, but sometimes it's like insurance, right? Nobody likes to pay insurance until you actually need it. And that's kind of what you're paying for sometimes with the professional fees.
Scott, would you add tax mitigation strategies? And that needs to be put in place upstream of the deal?
Yeah, absolutely. So, as part of this whole planning process, if your exit is selling, you're going to want to obviously minimize the tax too that's going to be associated with that. So the earlier you can get a CPA involved to help perhaps structure things or put things in a certain spot or help you structure the deal, that's going to be more tax advantageous for you. In a $300,000 transaction, you might be able to save $30,000 in tax. So it would be worth paying somebody $5,000 to do that. But again, you got to kind of do that ahead of time. What happens is a client will come to us and say, hey, I've negotiated this great contract, this deal. We're going to close in a week. Help me not pay taxes. That happens all the time. It's way too late at that point. But certainly that is a thing to consider, and a cost that could be beneficial to spend on a CPA looking at that and helping you save $30,000 in tax, perhaps. One of the things, it's very difficult for people is to communicate to their people, their management team. And I think the speaker this morning talked about the owner of that business there was only two of them looking at the financials and eating all these losses, and then they finally talked to the management team, and the management team was like, well, how can we help? It's scary to do that, to actually come out and say that, but if you can talk to them ahead of time, make them part of the plan, what we see is those are typically more successful, where everybody's on board, everybody knows what's going on, everybody's swimming in the same direction. It just makes the whole process easier. Again, it comes back to goals. So if you want to make it as easy as possible for your employees, talk to them, include them. Focusing on the end goal and adjust as necessary. Nothing goes according to plan. You all know that pretty well. COVID was a great example. But execute on that plan and adjust as you need to. And the reality is, these things are going to take time. So even if you have a buyer, a transaction can just drag and drag and drag, 30, 60, 90, 6 months. It just keeps going. Get them done. If you're happy and comfortable, get the deals done as soon as you can. We talk about this thing called deal fatigue. is a real thing. So as you're negotiating a deal, going through the process, people just get tired of it, and it just becomes this horrible, horrible process, which makes the exit and the transition just miserable for people. So if you can, keep it moving, get it done. Try to avoid dragging it out as much as you can. If you need to, for legal reasons, financial reasons, then you have to. But if you get it done, is my advice. And then, at the end of the day, in any good deal, everybody's happy. So the more you can do to help that successor, especially if it's a friend, an employee, somebody else, help them, communicate with them, talk to them, give them as much information as you can. And the reality is, most of the time, that's in your best interest to do that. Whether it's you're going to wind up with more money at the end of the deal, maybe you have to hold a note, so maybe you're going to get paid a little quicker. The business is going to be successful, your employees are going to be successful, your family's going to be happy. Setting people up for success will help make this transition that much smoother. One of the things that sometimes will get lost on a business owner is as you're going through a transition or a purchase, there's going to be some level of what's called due diligence that the buyer's going to do. The buyer's going to come in, a buyer's team might come in and say, hey, it's great, we're really interested in your business, but we want to see all of this stuff to make sure we really understand what we're buying. And this can be a very cumbersome process for business owners, especially small business owners, if you don't have great record keeping, great documents. This process these are the types of things that a buyer is going to ask for and want to look at before a deal is signed, sealed, and delivered. So it doesn't look like much, but all of a sudden it can take days, weeks, months to start pulling all these things together. And again, if you don't tell people what's going on, you may have to do all this yourself, and you may not know where all this stuff is. So part of that whole planning strategy is what are all the things we're going to need, who's going to need to know for us to be able to help and get all these things done. So we've planned, ideally we've executed, we've gotten to the point where there's a contract, there's an agreement of some sort, you're ready to go, and reality hits you. It is a very emotional process to exit a business. And it doesn't matter how you exit. If you started this thing, or even inherited it, bought it, you put a lot of blood, sweat, tears into it. And I don't care if you're the biggest, burliest guy in the world, it is an emotional process to go through. And I've gone through it myself, and I've done it. And I'm not an emotional guy by any means, but when you hit that last day, when you sign those papers, it's very, very emotional, good and bad. You've achieved your goal. But now you don't own a business, so what are you going to do? And that's where this next piece comes in, is understanding your role on day one. So if you sold 100% of your business, and part of that agreement was, well, we need you to keep working, help us transition the ownership. Maybe they do just want you to walk away. I can't tell you how many times we've gone through a transaction with an owner who on day one just thought things were going to continue on as usual. And they're like appalled a week into it when the new owner is asking them questions. Like, didn't you talk about this beforehand at all? Like what you were going to be doing? So really, again, comes back to communication. Like, what is expected of you on day one? What I see a lot is people don't want it. They sold the business, but they don't want to listen to anybody. Somebody bought your business. Somebody's paying you tens of thousands, hundreds of thousands of dollars. You now work for them. You're an employee. You got to do what they ask you to do. See that a lot, where it's just a lot of headbutting when people stay on if things aren't communicated real well. And then the last piece of this exit here is the financial implications of this. So, again, it comes back to understanding the terms of the deal, understanding what your role is. how the deal is structured. So you may sell your business for $300,000, but they may not pay you all $300,000 up front. They may give you $150 and say, hey, we'll give you the other $150, assuming the business continues to do well next year, but it's all dependent upon that. So in that case, you're going to have an earnout, what's called an earnout, where your payment is contingent on the success of the business. Hopefully you're still involved in the business to help make sure that happens. But again, you need to understand that, how am I getting paid, and what does day one and after look like with the new business? A lot of times with smaller deals, especially with employees, the owner ends up holding a note. So again, they may pay you a little bit up front, but then they're going to pay you over the course of the next 2, 3, 4, or 5 years. So you have debt. So again, as you're planning this, you may get that $300,000, but it may take you 5 years to actually collect that. So again, going back to your plan and understanding cash flow, very important. And then deferred compensation too. Some of the agreements have deferred comp elements that will pay you out over time as well for services performed. And again, it's just understanding that and understanding the timing of when you're going to get paid and some of the tax implications of that too. So it all comes back to cash flow and what am I going to wind up with ultimately. So to recap, some of the mistakes here to avoid. Again, doing it by yourself just is hard. It's going to save you money, to your point, but it's hard, it's tough, and you may miss something, and you may miss something that's pretty critical. In a $300,000 deal, sometimes we hear, well, how bad could it be? It's only $300,000. Well, there could be some environmental liability issue, let's say, with the property you sold and it never was disclosed. They're going to come back on you and want that remediated. You're going to have to pay for that. So again, doing it yourself, doable, but risky. Assuming everyone is on the same page, again, don't assume anything in these. Talk about it. Talk, and document it. Trusting people's great, and I know there's a ton of trust and camaraderie in the brewery community, but business is business sometimes, and oftentimes we see friendships, trust, don't always make it through a deal. So get it in writing as much as you can. Ask questions. Ask questions of the buyer. Ask your advisors too. People don't always ask us questions, but ask so you know. Second guessing is hard because it's going to happen. You're going to do it. I've done it. I still do it to this day on deals we've done. And they're done and over with. They're long gone. And then not planning soon enough. It's never too early to plan for this stuff and think about it. You don't have to spend hours and days and weeks and months on it if you're 20 years away, but starting the process is important. So again, start early. Try to avoid the surprises. They always come up. Work with a purpose. That's a big thing for me, not just in something like this, but in life, in your day-to-day, have a purpose and work towards that. Have goals. It just helps make things easier. Identify those advisors, execute, try to make the process as easy as you can. The more you give and help and work with a buyer or whoever it is that's transitioning, the easier it's going to be. And it's going to help with those emotions too. And at the end of the day, enjoy it. You built this thing and got it to where it is, and hopefully the exit is a happy time and not a sad time, but they can be fun for sure. And even in the distress situations, we've seen it where people have been stressed, and that day they finally get into bankruptcy, there's a sigh of relief of, okay, I did it. Not ideal, but we got it done. And life gets a little better. So I'm happy to answer any questions anybody has. Contact information is there. I'll have cards up front. if you want to chat it all offline here. But any questions, thoughts?
I have a question, Scott.
Yep.
I've heard, or I'm aware of like merger and acquisition brokers, M&A people that help you. Is there a general percentage or range of cost that is typical by, that they serve as kind of a quarterback of, getting yourself together and getting them. So is there a general range of cost that would be?
Yep. So the question was, if anybody didn't hear it, the cost of a business broker and how that looks. We have one sitting in here. Dean does this. So those fees can range. They're typically going to be a percentage of the deal. So if you have $1 million deal, that fee percentage may be 2%, 5%, 10%. It will vary depending on the size of the deal. Some will do just a fixed fee and say, we'll do this, we expect it to be this, we're going to just charge you $10,000, flat fee, no matter what it may be. But they do range based on size.
The bulk of the industry, I'll add, uses the reverse Neiman scale. I was just looking at the survey, the fee schedule at the M&A level, but even at the Main Street business broker level, small businesses like we're talking about here, somewhere in that first $1 million might be 10%, then it goes to 9, the next million is 9, the next million is 8. Sometimes it's a 2% drop, it might go to 10, 8, 6.
Is there a typical period that you're seeing presently where, okay, you've got the book of business and all your records in order, and now you're essentially out there marketing? What's the typical time period you see from start to close on that marketing process currently? I'm sure, back in the days of all the acquisitions and mergers that were going on with AB and everything else, it's probably pretty rapid. I'm curious, is there any kind of metric that you're aware of now, start to finish?
Industry average from the time you launch your marketing, and there's always a couple of 3 months of prep work, packaging, due diligence, evaluation. 9 months is the industry average. The strategic outreach, where who's ever represented can identify likely prospects, and they will knock on their door in one way or the other. You might shave a few months off of that, but even from the time of the deal, and this was in the survey we showed too, it's usually 2 to 3 months before your closing date. It takes time, even if you have a great business and a great advisor.
Especially in this industry too, where you're dealing with licensing and different things like that, where you've got those issues that need to get dealt with, where you have a state agency that may be involved, you're stuck waiting on them sometimes. So it can take time, and that was the average. We've seen deals take 2 years to come soup to nuts, and some come really quick too. It can happen fast, just depends. All right, well, very good. I appreciate it. Again, happy to answer any questions here offline. Thank you.